Hi, good morning, everyone. Welcome to Phillip Securities Research Morning Call for 8th of March. Today, we will have a few stock counter updates, including UOB, Hyphens Pharma, Dasin Retail Trust, CapitaLand, Q&M, and Asian Pay TV. And then we'll also be talking about SG Banking Monthly as well as our SG Weekly. So without further ado, let us begin. Starting off with UOB results for financial year 2020. Next. Okay, so for UOB, the positives include a resilient interest margins. Net interest margins improved 4 basis points quarter on quarter to 1.57% from 1.53%. Moving forward, we are expecting NIM to remain stable with funding cost adjustments and loans to deposit ratio to be able to be improved on to manage some of the margins compression. Secondly, we also saw robust growth in fees and commissions for UOB. It was a 2% quarter-on-quarter increase and 10% year-on-year improvement, despite usually fourth quarter being a slower quarter. Year-on-year, the growth came from wealth management and fund management fees, saw double-digit growth, and for quarter-on-quarter credit card fees with a second consecutive quarter of double-digit growth for UOB. Next. In terms of negative, we saw that UOB still had weak trading incomes. Quarter-on-quarter, it was down 21%, and year-on-year, it was down 33%. I think the quarter-on-quarter decline was due to some of the realized of investment gains on the previous quarter. But generally, overall, trading income was down this year due to the volatile markets. And with volatility expected to stabilize in this year, we are expecting the trading incomes to perform better. And secondly, we also saw that there was an uptick in specific provisions. 200 out of the $396 million in allowances that was recorded for the fourth quarter, 241 million of it was for specific provisions. And this is the highest quarterly specific provisions for the entire 2020. However, we do note that this was after them having looked through some of their loan moratorium relief programs, because apart from the government relief program that they provided, there was also additional relief program that was provided by the bank to the customers. So current loans under various moratorium relief, both government and non-government, self-initiated ones, are at 6% of their total loan book. And we see that the credit cost is likely to improve from 57 basis points in 2020 to about 30 to 40 basis points in 2021. Next. In terms of outlook, we are expecting UOB to benefit from the trade flows within Asia itself. So we see that there's economic recovery to support some of the trade flows between China and ASEAN region, and having a stronger footprint in ASEAN will benefit UOB. So UOB actually saw their loans grow 4.4% in 2020, despite slower economic conditions in 2020. And so moving forward into 2021, with everything improving, we are likely to see their loans improve by about 7 to 8%. In terms of dividend, UOB declared a final DPS of 39 cents to bring full year 2020 dividends to 78 cents or 45% of their payout ratio. So we know that this is the cap that they can with the MAS 60% cap. And moving forward, once restrictions are lifted, they are expecting to resume their 50% payout ratio. And based on our forecast of their earnings in 2021, this will be about $1.20. With the higher profitability that they should likely see in the year, and their high CET1 ratio of 14.7% will also support this dividend of $1.20. In terms of our recommendation, we are upgrading from neutral to accumulate, and we raised our earnings by 22% to reflect a strong growth in fees and commission and lower credit costs. And also net interest income will also be boosted by the loans growth, as mentioned previously. In terms of our model, we lowered our cost of equity from 8.9% to 8.5% on lower risk, and our target price was raised from $21.10 to $28.70. And that's it for UOB. I'll now be talking about Hyphens Pharma. And they're not to be written off. Next. For Hyphens Pharma, I think for the fourth quarter, a lot of the underlying trends that we see for the entire financial year 2020 was intact. And in terms of the positive, we still see that there's very strong proprietary brand sales. Year on year, in the fourth quarter itself, it was up 22%. with the growth squared evenly on Ceradan and Ocean Health. And this is some of their long-time brands that they have under their, okay, for Ocean Health, maybe a little bit newer, but we see that all these new proprietary brand sales actually have a very positive impact on their margins with a better revenue mix across their 3 different business segments. Moving forward, next. In terms of the negatives, I think some of the things that was weakness that we saw in 2020 was the same in the fourth quarter as well. First of all, we have a weaker specialty pharma sales. I think movement controls in Malaysia and Vietnam affected them. And we see that there might be some lingering weakness in the first quarter as well, especially for Malaysia, who was still experiencing lockdowns across January to February. And secondly, in terms of inventory obsolescence, we saw that for Hyphens Pharma, they had some PPEs, test kits, and specialty pharma inventories that they continue to write down because of the inability to sell it off to the market. And I think this is a prudent write-off following the third quarter write-off. They already eyeball some of these that are going probably not likely to be sold off. And as such, we do not expect to see this kind of inventory obsolescence level to recur in 2021. And in terms of higher operating expenses, lastly, we see that distribution cost was higher as they ramped up on promotion and advertisement efforts to resume the sales as some of the economies start to recover. And we also see that they have R&D for their products, especially with their expanded product portfolio. We expect some of these operating expenses to continue trending upwards in the near term to help to boost their portfolio attractiveness as they expand. Next. So in terms of outlook, I think they still have a very intact growth outlook. First of all, they over the past quarter itself, they actually got their successful e-pharmacy license applicant. I think this was announced just earlier this year, sorry. And secondly, they also appointed South Korea-based JS Pharma to distribute their skin pigmentation product, Ferens, in Korea. So I think being able to have interested parties to take on their skin pigmentation product in Korea, which is a very competitive market, gives recognition to their product effectiveness. And this will help them to grow their footprint in the Asia region, not just in the Southeast Asia region previously, where they have a stronger presence. And secondly, in terms of rationalizing their dividends, I think for financial year 2020, they declared a dividend per share of 0.62 cents per share. This is in accordance to the 30% payout ratio that was previously guided by the management. And I think as the company try to reinvest for growth in the future, we are expecting them to stick to this 30% payout ratio. So just for context, the 1 cent that was declared for 2019, was actually about 50% of their payout ratio. So moving forward, we think that it would be about a 30% payout ratio. In terms of recommendation, we are maintaining a accumulate call with a slightly reduced target price of 34.5 cents. Long-term profitability, we think that will be supported by contributions from newer products and expanded geographical footprint. And however, we feel that some of the short-term cash flows will be impacted as they have some reinvestment efforts into the business. Next. Now we'll be talking about the Singapore Banking Monthly. So I think the Singapore banking sector is looking better as we enter into 2021. Next. Okay, in terms of the banking sector, we are upgrading from neutral to overweight. And first of all, we see that interest rates actually started to pick up slightly in February, but I think most of it is just to reflect some of the expectations of rate hike around the world, especially if there's an inflation build-up. They believe that the Federal Reserve might have to hike the rates earlier, just to combat these inflation pressures. However, short-term interest rates, we are expecting it to remain low. We do not think that this will be very volatile in the short term. So net interest margins we saw across the banks was actually up 1 basis point from 1.53% to 1.54% quarter-on-quarter on average across the banks. Mostly because over the past quarter we saw very stable interest rates, and this allowed the banks to actually control their funding costs better. In terms of net interest income, also we expect it to improve on loans growth despite some of the margins pressure that we are seeing right now. Next. In terms of lending, lending actually the recovery that we saw in the loans growth segment actually continue to recover in January, although it's still down year on year by 1.09%, but this is the third consecutive month of improvement with growth month on month at 0.72% in January itself. And so this is also the first time since November 2019 whereby both business loans and consumer loans saw growth together. There's a broad sectorial growth month on month, with the exception of agricultural, mining, and quarrying declining, as well as credit card loans declining. In terms of 2021, we are expecting healthy loans growth of between 5 to 8% across the three different banks that will benefit from the regional trade flows on better consumer and business confidence. And next. So, and thirdly, we also see an improved credit outlook for the Singapore banks. So for the general provisions that was announced for the fourth quarter, they averaged about 15 basis points in terms of credit cost. And this was down from the 31 basis points for the entire year of financial year 2020. And this is expected to normalize in financial year 2021. So about 10 to 15 basis points in GP credit cost. And we also saw that the loans under government moratorium actually fell to roughly about 1 to 2% of the loan book across the three banks. And they are all largely on a secured basis, meaning to say that what we see in the increase in GP reserves that they have provided for the entire 2020, of about increase in about 45 to 55% increase in GP reserves should provide sufficient buffer for asset quality deterioration in 2021. So what this means is that whatever higher expenses that they have provided for in 2020, as if there are certain loans that are going bad in this year, if they were to happen, the banks can actually just charge it to the GP reserves instead of having to take on additional expenses for all these extra impairments. Next. However, in terms of market activity, we actually saw that market activity fell in February. So securities daily average value fell 3% year on year in February. And when we see the top 5 equity derivatives futures actually fell 27% in February as well. And I think the weakness, we can attribute it to a higher base from a year ago, and as well as the Lunar New Year holiday this year. And I think if you compare it on a month-on-month basis, what we saw in February was actually pretty comparable to the February numbers. So this is not a very alarming figure. However, moving forward, we think that compared to the higher base that we saw over February, March, and April last year due to the start of the pandemic when there was a lot of market trading activity, comparably year on year, it might be slightly weaker over the next 2 to 3 months. Next. So as the investment action, we are upgrading the entire sector from neutral to overweight. I think generally we have a few tailwinds for them. First of all is that the healthier loans growth in 2021. Secondly, we have fees and commissions to lead some of the income growth that they are likely to see, especially from the wealth management side. And thirdly, they will have also leave some of their credit costs in 2021 as well. We upgraded our OCBC call to buy and DBS and UOB to accumulate. And our sector preference is for OCBC, which is likely to benefit more from its insurance and wealth management franchise. And that's it from me. I'll now hand the time over to Natalie, who will be talking about CapitaLand.
Thanks, Wee Kwang. Okay, so I'll be talking about CapitaLand's FY20 results. Next slide, please. So starting off with the results at a glance table, we can see that gross revenue grew by about 4.8%. This was due to higher handovers from the residential projects in China as well as in Vietnam, as well as the full year contribution from Ascendas Bridge, which was acquired in June 2019. This was partially offset by 230 million in rental rebates and weaker performance from the retail and lodging businesses. So overall, EBIT fell by about 95% due to fair value losses from the investment property portfolio, as well as lower portfolio gains from asset recycling. Total PATMI, which comprises 3 items. First of all, operating PATMI. Operating PATMI is from rental of investment property, as well as fee revenues from their lodging and their fund management platforms. These are recurring in nature. So operating PATMI it was still positive. Portfolio gains, they managed to achieve 154 million in gains from divestments, revaluation losses and impairments. This is the one that made the whole P&L turn red because of a very significant almost 2.5 billion in revaluation losses and impairments. But overall, cash PATMI, which comprises operating PATMI and portfolio gains, you can see that these two items were both positive. We need to say that there was a cash gain. So jumping into positives, on the positive side, a strong momentum in residential sales continued. In China, strong demand and higher average selling prices lifted sales to 14.8 million renminbi, and this was 12.1% higher year-on-year, despite a 3.2% decline in the number of units sold. In Singapore, the number of units sold was up by 5.3 times, half on half, for the second quarter of 2020 on the back of strong demand. So this is expected to continue, backed by consumer confidence for residential products. For the full year, despite due to the 10-week closure of show flats and absence of new launches in Singapore, the number of units sold actually fell by 56%, down to 220 units in Singapore. CapitaLand's lodging arm, the Escort Limited, signed a record number of 14,200 keys in FY20, despite it being a very difficult year for the hospitality sector. So this brings the number of keys under TAL to 122,600 keys, and of these keys, 43% of them have yet to commence operation. So just as a recap, the management previously shared that for every 10,000 keys that are signed and turned operational, this will bring about 25 million in fee income annually as the properties progressively open and stabilize. So in FY20, they didn't manage to open a lot of new properties. There was 3,900 units that turned operational. So a lot of the units that were supposed to come online will now be pushed into FY21. That means that about 17,000 keys will become operational in FY21. So we also note that CapitaLand did manage to achieve its $3 billion divestment target. So they divested slightly more, 3.04 billion in assets. This compares to last year, where they actually managed to divest 5.9 billion in assets. So this time round, they realized 154 million in divestment gains. Apart from that, the group also reinvested some of their gains and recycled capital into new economy assets, such as your business parks and your high-spec assets, logistic assets as well. Overall, the committed occupancy for the retail, office, and industrial portfolios were resilient. If you look in the graphs on the right, you can see that this is the performance of the various portfolios within the markets. So generally, still all above 85%. Next slide, please. Now touching on the negatives. So I'll just talk a little bit about the revaluation and impairment losses. So CapitaLand recorded 1.6 billion in revaluation losses and about 860 million in impairment losses. So this revaluation losses, the 1.6 billion, it's actually 4.7% of the group's investment property value. So it's not actually that large, even though in quantum it is large. And this was driven primarily by 5 assets, which accounted for 55% of the losses. So Capital Mall Westgate, Raffles City, Chongqing, these 2 assets in China, as well as Changi Jewel Airport. These 3 assets are still in the ramp-up phase, and they were opened between 2017 and 2019. So as such, the operations were more affected by the COVID-19 disruptions. For Tianjin International Trade Center and Ion Orchard, these 2 assets suffered from lack of MICE and tourist spending due to the border closures. Yeah, so in a sense, the revaluation losses were concentrated on very specific assets for very specific, like more or less COVID-related reasons, rather than it was a deterioration of the entire portfolio as a whole. In terms of impairment, about 50% of the impairment losses were actually attributed to one particular item or one particular investment. This was CapitaLand's 20% stake in Hong Kong listed counter called Lyfang. So the reason for this impairment is that Lyfang is a developer stock, so it's also quite thinly traded on the Hong Kong exchange. And previously, because CapitaLand believes that there has been a strategic change in Lyfang's strategic direction, and it has diverged away from CapitaLand. As such, instead of holding it as an investment, now they're going to hold it as a financial instrument for sale. Basically, they have actually taken a mark to market on this particular investment, and they are looking for buyers for their stake of this property, for this investment. Yep. So as such, they recognized the 50 impairment loss. So in terms of outlook, CapitaLand continues to diversify, aims to diversify their portfolio. First of all, of course, through focusing more on new economy assets, because we know CapitaLand to be more of a lodging, retail, and office player. So now they are trying to focus more on new economy assets such as business parks, data centers, and logistic assets. And of course, they will also continue to drive their recurring fee income through two of their platforms, which is one of them is the fund management platform, and also the lodging platform. So they have ambitious goals for both of these platforms. For fund management, they want to reach 100 billion funds under management by 2024, and for the lodging platform, they want to sign 160,000 keys by 2023. Yeah, so overall, we maintain our buy on CapitaLand. We lower our RNAV from $3.82 to $3.75. So our target price actually dips due to lower development and investment property book values as we roll forward our estimates. And there's a partial offset from a change in methodology for CapitaLand's the Escort Limited. Okay, so our earnings per share was lowered by 15% from 40 cents to 34 cents as we lower our rental income from investment properties and push back the residential recognition. So overall, CapitaLand is still our top pick in the sector, and we favor it because of the high proportion of recurring income and its pivot to new economy assets. They are expected to keep the earnings stable and future-proof its portfolio. So that's all for CapitaLand. I'll move on now to Dasin. Okay, so this will be Dasin's full year 2020 results, and just as a disclaimer, this is actually a paid research arrangement, so we have received monetary compensation for the production of the report. Next slide, please. So starting right off with the results, in terms of gross revenue, it grew by 15.1%. This was due to the acquisition of Shunde Metro Mall and Taipei Metro Mall. So these two new malls were acquired on 8th of July 2020, and they contributed almost 10 million and 0.7 million in revenue towards the year. This was offset by 8.6 million in rental rebates provided to tenants. So as you can see, net property income actually grew by 16.8%, meaning to say that Dasin actually managed to improve their NPI margin. In terms of DPU fell by about 42.2%. So this was because, if you recall, Dasin actually has this arrangement with their cornerstone shareholders, where the number of units that are under distribution waiver, meaning the shareholders actually waive their rights to distributions, it will actually step down over the years, and eventually all the units will be entitled to distribution. So this stepping down of the distribution waiver will actually enlarge the number of shares, or rather the share base that is entitled to distributions. So that, as well as the fact that there was a preferential offering, which also increased the number of share base. So this added to sort of a lower DPU for the year. In terms of the positives, FY20 cash rents recovered to about 95.8%. So, 24% of the leases by GRI are actually in some way tied to the tenant's turnover tenants turnover. So about 4% of them are actually pure turnover rents, and the remaining 20% are on a higher of base rent and turnover rent kind of lease structure. So with the retail sales actually growing, in fact, it has actually returned to growth in 4Q 2020. We believe that the variable rate leases have largely been de-risked. Portfolio occupancy also increased. This is a smaller increase, 96.1% to 96.5% quarter on quarter. However, we do note that this is actually still below 4Q 2019's occupancy of 98.8%. In terms of outlook, we note that there's a significant 33% of leases by GRI that will be up for renewal in FY21, and half of these renewals are actually attributed to two tenants. So one of them is a furniture tenant at Ocean Metro Mall that has indicated that they would like to renew. Another tenant would be, if you recall, in November 2020, there was actually a pre-termination of a remaining 9-year lease with this departmental store at Ocean Metro Mall. So it's a relatively significant, almost 17% of space that they took up in the mall, and it was renewed on a 1-year lease to another party. So that means that the 1-year lease will be up for renewal in November of 2021. So that accounts for the remainder of the 50% of the leases. So there will be opportunities for Dasin to unlock higher rental reversions through AEI. So earlier in 2020, they actually did a AEI for this about almost 10,000 square meters of space, where they actually carved up the space that was returned by a furniture and finishing tenant, and they sort of repositioned the area of the mall and targeting children and education kind of segment. They managed to achieve rental reversions of 46% by doing this AEI. So similarly, we can expect that Dasin will be carving up the space for this that was returned by this departmental store, and will be renting it out to smaller tenants, thereby increasing the diversity of tenants within the mall. Yeah. Apart from that, Dasin, of course, all of their assets are located within the Greater Bay Area, so they will continue to benefit as the Greater Bay Area develops into a booming financial hub. So in terms of our recommendation, we downgrade to accumulate. Our target price is lowered from 90 cents to 82 cents, and we lower our rental growth assumptions to factor in the weaker leasing demand. FY21 to FY24 DPUs have been cut by about 13 to 16%. So that is all for Dasin. I'll now pass on the time to Paul.
Okay, thanks, Natalie. I'll move on to Q&M Dental second half results. Major turnaround underway because the second half numbers saw a big turnaround in their net profit. Next slide. Okay. In terms of the positives from the results, you can see that the red column, the revenue saw a big jump, about 26%, and most of it is all organic. So part of the reason is actually the border closures help them, because I guess everyone is stuck at home or working from home. So this allows households to visit their dentist more regularly, and also they can opt for elective procedures. The other factor was the border closure actually raises the capacity of the dentists, because most of them are again stuck in Singapore. So but by default, the capacity is higher and they can actually do more procedures in Singapore. The other positive from the results was the balance sheet. So the net debt declined from 75 to 20. In part, there was free cash flow generated 19, but also late 2019, they actually sold one of their investments, IDT, and they got that 47 million early 2020. The other thing for us that was positive was we saw the maiden revenue from PCR. So PCR, is the COVID-19 PCR test, and just as a refresh, they make revenue from the PCR test firstly from selling the kits. So they actually created this kits from this company that they bought, this 51 subsidiary that they bought called Acumen. Then the second source of income is taking the laboratory testing of all these PCR, which is even harder because, as you know, you're handling virus, so authorities are not going to give you this license so easily, number one. And number two, you're actually testing the genetic material. So no, this is not like your typical blood test or healthcare test or your health checkup kind of test. This is you're testing genetic material. So the amount of investment for equipment is also higher. The negatives was the pandemic. I mean, the flip side was they were not able to grow their clinics. And in FY19 they expanded clinics by 21, but because of the pandemic, the lockdowns, so they could grow by 6. So in terms of the outlook, we expect another record year for them in FY21. So there will be 3 drivers for them. Firstly, will be increased patient admissions, and of course the higher availability of dentists that we mentioned earlier for procedures. So actually these things actually do help. The other thing would be the expansion of clinics. For them themselves, I think they mentioned that they are looking at, in the results announcement, they're looking to open at least 30 clinics. So 30 is big because 30 is like 25% growth in their 118 clinics, and most of this would be in Singapore. For us, we are just modeling 25, I mean, just in case, but to meet this, they're also boosting up the amount of human resources to grow. I think, as you know, Q&M in the past, when they started, they did a lot of acquisition and they realized that the organic was the most sustainable way to grow. So the third growth driver would be, of course, the PCR, the sale of the PCR kits and the lab test itself. And just over the weekend, I think the ministry has also mentioned that in one way to replace, if visitors come into Singapore, to remove a stay-home notice, they will have to do more PCR tests. And now they're looking at 60,000 PCR tests in terms of capacity. The other thing to note is that in the announcement, the company announced that they're going to be providing quarterly updates from FY21 onwards. In the past, they were doing only every 6 months, but I guess we all can read there must be a reason why you from 6 months you want to do quarterly results. So hopefully these are good numbers, I presume. So we maintain a buy. We nudge our revenue a little bit, our forecast, and I think our target price is 20 times PE. Again, like we highlighted before, it's not easy to kind of get the right PE number because their PEs can be quite high in the past, and then there were a lot of exceptional games. So what we did, we just took a 50% discount. That's how we got the 20 times PE. It's pretty hard because their PE valuations swing a lot, and there's a lot of core earnings that you have to strip out. I mean, there's a lot of one-off gains to have to strip out. Next slide. We move on to Asian Pay TV. So for us, you are getting a 9% yield, and I know everyone will be asking, when is the 5G? And we are still waiting for the 5G, but at the same meantime, we are getting that 9% yield. Next slide. Okay, so for the positives, when we look at the numbers, for us, we focus a lot on the core, the adjusted free cash flow. Basically, in the report, we take the EBITDA, but EBITDA don't count tax, don't count a lot of stuff. So we just, our adjusted free cash flow means we take the EBITDA and then we take out capex, we take out interest. So we take out really the core, we take out all the other expenses, not just rely on EBITDA, which assume you don't have to pay tax or anything. Or even interest. So we take out interest, we take out everything to get a cleaner number. So for us, the adjusted EBITDA actually rose for the year from 29 to 67. And also year on year for the fourth quarter, you can see it has actually improved quite a lot. Part of it is because of the capex. So they dropped capex by almost 1/3, 29% to 21. Or for the quarter, you can see it's about 8.7. The negatives for us is the core cable TV. If you look at the table on the left, basic cable is 60 million, so it's about 64% of the revenue. So it's really important, but there's a structural decline. So that is the worrying thing is that's the steepness of this decline. So, but eventually what we think is that at $23 for 100 channels, there will be some support. But again, we are still modeling a decline, but this is the negative. But more important is that the cash flows, adjusted free cash flow can cover the dividends. You look at the table, that 16 million more than covers the quarterly 4.5 million that they need to pay to keep the 1 cent. So in terms of outlook, we think that operating cash flows can sustain this quarterly dividend of 0.25, and we're just waiting for the growth in the 5G backhaul. They have yet to give any guidance, but they in the results, they just, in the slides you can see they actually give more details about what it will become. But again, we can't model because they're not really given any numbers yet. Yeah, okay, in terms of our recommendation, we still maintain a buy. I think that 67 million of free cash flow can support the dividend payout and keep that 99% yield, which is paid quarterly. Our target price is based on the 9 times EV EBITDA, a discount to the Taiwanese peers. Next slide. Next slide. In terms of our weekly updates, just a quick flash on some of the key macro numbers. For Singapore, the PMI was quite, I think it's reasonable. I mean, because there's a lot of seasonality because of the new year that happened in February. So tourism arrivals was still bad. I think actually got worse. January was 23,000 in February 17. A year ago, it's, I don't know, that usual 99% kind of drop. The retail sales are also weak, but again, all these are festive season, so it's very hard to get the correct read. And supermarket sales was also weaker. So we need to wait until February, then we get the January-February numbers to kind of iron out the festive period. In terms of the US number, the payrolls was good, but we will explain later, but it is still 9.5 million below from a year ago in terms of the number of people. So 9.5 million people are still out of job in the US. I will touch a bit on the Phillip on the ground for those who did not attend the PropNext webinar. Also, technically, we are still positive on the market. I think we'll show you a chart later and explain. Equities do rally during a rising interest rate environment. And for this time, we're going to get a big cyclical recovery boosted by the reopening as the COVID numbers come down. Of course, we have our Biden fiscal stimulus, and we have this huge pent-up demand, predominantly in services, of course. For this week, we will have a few. Tomorrow, we will have Escort Trust. So feel free to look for. Feel free to sign up. And then we have MC Payments and Golden Energy, a late one that came in. And next slide. Okay, as usual, we still have to look at the daily COVID cases globally, which is the blue line, because this remains the key driver for global growth if they ease on the lockdowns. So right now we are still dropping month-on-month about 26%. So that's a positive. And right now almost 300 million have already been vaccinated. Next slide. The other one is in Singapore, we still get cases. I think that 4 community this week and last week is still the same. What the minister also mentioned that they're trying to look for more air travel bubbles. Depending whether our neighbors want to do it, but we're still looking. And one of the key things they're looking for, the key scientific data is also whether if you are vaccinated, will you be less likely to carry? I think that's one thing that we repeatedly said, because although vaccinated, they're still not sure whether you can still pass on the virus. You protect yourself, obviously, but you can still be having the viral load and then passing on. That's what the authorities say, it's not me. Next slide. So in terms of why we did this chart is just to show you that, because the worry everyone has right now is that the Biden stimulus could actually overheat the economy. But just looking purely at the jobs data, it don't seem so. From a year ago, you can see that from the data here, we added, for February, the US added about 379,000. But most of it, almost 80-90% comes from the leisure and hospitality, which is food services, the 285, which is quite, not kilometer 1,000, which is quite volatile. And secondly, there's still 9.47 people. One way to read it, 9.47 million Americans still out of job. So even with the stimulus, I'm not sure, again, how much would this be safe and whether would this actually be overheating, leading to the Federal Reserve having to raise rates and because of the surge in inflation. So from this read, there's still quite a bit of slack, at least in the labor front. Next slide. Okay, with all this talk about rising interest rates, so we just wanted to have a look how the equity markets perform during rising interest rate environment. So the blue line is the S&P 500. The red line is just interest rates. Of course, it continues to go down to record lows. The key one to watch is the beige line, the beige bar, sorry. So this beige bar is what is when the red line actually spikes. Whenever there's a spike in interest rates, which is the red line, we want to see how the US markets perform. And from there you can see, I mean, most times it has climbed. The only time is during the 93, 94 when interest rates spiked. I think the S&P actually went down. So you can see, I think you can look from the chart. I mean, 2004, 2009, whenever the rates rise, the market can rise sometimes 30 to 40%. Likewise for 2018. And what actually kills the market is more the recession call. So the first point is just that to show that even though rates have rise, it's still below the pre-pandemic levels. And then historically, you can get like 30-40% increase even when improvement in the S&P, even when and we actually did get a big spike before. You can't really see from the chart, but in 2016, we got a really like 100 basis points surge in interest rates because of the Trump. Trump was going to do, when he came in, he was going to do that big tax cut, which he did, but the market rallied instead. So we're not saying don't worry, but we're just saying that in rising interest rates environment, the markets actually can run if there's global growth to accompany it. And number two, the Fed doesn't surprise everyone and start to raise rates. Next slide, I think that should be, sorry, the last one is, so for those who did not attend, and because we don't do a recording, I mean, most corporates do not want us to do a recording. So I'll just give you some highlights of what they mentioned. So in terms of cooling measure, the hot topic, so from their perspective, a double-digit rise is not sustainable in the residential property index because from their lens, which is obvious. I mean, because in 5 years, if you get like 9-10%, in 5 years you're going to get a 50% jump in residential price, which is a no-no. Obviously, is not authorities are not going to tolerate that. The worry was that although the last 12 months property price was only up 2%, most of the increase came on the last quarter, the fourth quarter. So what you worry is that if the first quarter numbers come up and the property price index go up 3% and more, then it can be worrying, because if you kind of like normalize it, it could almost hit 10%, because 6 months is 5%. And then, so that one is the time when you should worry if the index climbs up too much. So that will be a number to watch at the first quarter URA property price index. From their perspective, what would be the intervention? Less likely the ABSD, because whenever you put ABSD, they still come in and the market price to go up. So what they're looking at is maybe they will lower the TDSR, the affordability to pay from 60 to 50. The other thing is resale market is strong because there's almost like a 30% discount from new launches, and buyers are looking for space. I think the rest, okay, the other area that Propnex is entering is the en bloc market. So what they said was the last 2 years, almost 100 en blocks have failed. But from them, they think they have an edge because they understand the ground, obviously, because they are very close to the buyers, and also they have very good links with the developers. So they are looking to get some en bloc, well, of course not the huge ones, but to be involved in the en bloc market and generate some revenue from them. I think the other thing is, of course, one of the questions was on their competitive edge. So for them, of course, they have got a huge sales force, but without productivity, there's no purpose to have a good sales force. So for them, productivity is that they train them well, and then they give them a lot of technology tools. And then just one last point, sorry to keep this so long, but they just wanted to remind everyone that every year there's still 8,000 to 9,000 units of being sold. And so there is some captive demand every year, and there's no like sudden tail off, there's no new launches being sold. So they just want to say that there is some sustainability in terms of new launches. Yeah, I think that's it for me. I think we can go to Q&A. Yeah, thank you everyone for listening. We got this. I will try to answer this question. Hong Kong plans to increase the Hang Seng Index to 80 from 52 and include EW, tech companies. Sorry if I read this wrong, EW. What's the impact to Hang Seng in the tech? What's the likelihood STI will undergo the same restructure? Example, Add Nano, Film, AEI, Venture, UMS, and the likely market reaction. Yeah, I think even the problem we have is that even if the STI were to add some of the tech stocks, of course it would be helpful, but it won't really change much because a lot of our tech stocks are quite small. So that's to give you some context. Venture is about 5 billion plus, and their weighting in the market, STI is about maybe 1.7, let's say 2% roughly. And then the other three, like nanofilm, you add them up, maybe UMS will be equivalent to venture. So even with all these five, so they will add maybe another 2 percentage points or less. So even if you add the tech, it would be very small component of the new STI tech, unless they take out the rest. But the problem we have is that our tech stocks are very small. The largest is venture, 5 billion. You look at Tencent is like 100 billion. So the impact may not be that high, that's significant for us, even if we do add. Of course, there could be a bit of trading opportunity for some of these stocks, but in terms of them being an influence on the STI, it will be smaller because our tech sector is so tiny. But Tencent, Alibaba, like 100 billion Sing, like 3 times, I mean, almost double, or some of them are not double the size of DBS. Some of them. So it'll be tough to get them to be meaningful. I hope I answered. I don't have all the data, but just from some quick checks. The other question is news headline: all HDB car parks in at least 8 towns to have electric vehicle charging points by 2025. Who benefits from this plan? ST Engineering. I'm not sure, Terence, if you can help, but for car park, I know one listed company that does car park, which is LHN. But in terms of charging station, I'm not sure whether the Semcon Industries or Capital Corp might enter it. I'm not sure if you mentioned it. Terence, do you have anything on it? But for car park management, I know one listed company that does it. That's LHN. I can ask them.
Yeah, hello, Alex.
So you wait for Terence. The spec question, can you, Junong, can you help answer the spec, because the US specs? What's the criteria for them? Yeah, before I kind of say anything. Yeah, thanks.
Yeah, sure. Thanks, Paul. So there's a question on spec. He mentioned that SGX hopes to list spec as early as next year. Can you explain to us the layman, the concept, the investment potential for retail investors? Okay, so generally for specs, okay, the layman concept is that it's basically a shell company. So it doesn't really own any businesses yet. So it's set up to raise funds from investors with the ultimate aim of acquiring other companies. So if you think of it between the difference with IPO, you can think in terms of IPO as maybe the company is looking to raise money, but in terms of spec, it is actually the money that is actually looking for a company to acquire. So why it's so popular now is because it actually it can shorten a lot on the IPO process. So a usual IPO process will take like maybe a few months, but spec it can take just up to 8 weeks, roughly 8 weeks. But the downside for retail investors is that because it actually skip a lot of those processes because you don't have to file with the SEC and all that. So the due diligence part may not be as robust. Okay, and another thing is that when you buy into a specs, basically you are because you may not know the end target of the acquisition. So you are just buying, you are just looking on the reputation of the person who raised the fund, and then you are buying it based on this investment decision. But the good thing is that for SPAC, actually they allow investors to vote whether they want to pull out. For example, they announce an acquisition target. So you as an investors, you can decide whether you want to go ahead with the acquisition, or you want to actually revoke your share and then just take back your money. Yeah. Other things is that for SPAC itself, usually they have a 2 years period. So within 2 years, mainly they have to find an acquisition target. So this may create a problem of them having to overpay for a certain company, because if they don't acquire within 2 years, they have to return the money to investors with additional interest per se. Yeah, so for you as an investor, even though you can choose to revoke if you do not like the acquisition, but just to take note that for example, if they raise an IPO like at $1, but if you buy it at a market price of maybe $2 because of a potential growth prospect and all that, ultimately if the deal fall through, each share ultimately will still be worth $1. So you may have opportunity to lose money on that. Yeah, hopefully this answer your questions. Yeah.
Some although we don't really like the concept, because it's really so hard to analyze a company. You analyzing a company, you don't know what they're going to buy. But I think some people don't mind going at the IPO level, because essentially once you do the IPO, they are all at cash. I mean, because although you can vote, but at least you are still holding cash at the time. I think maybe that is one way people read it. But again, not very favorable for specs. But that would be one way investors see, because if everyone just put in cash, so at least even if I buy IPO, it's still a net cash company, then depending on what he buys. But actually, Malaysia has specs, and until the US one came out, it's a bit mixed up, because some of the acquisitions are not like the best acquisitions out there, because you're assuming they make a good buy, which I don't think all will do so. I hope that helps. I mean, yeah. But Malaysia is there's one other place to look at. Jerry, can you answer some of us, the Yoma ones?
Okay, yeah, I have a couple of questions for Yoma. So I'll just read them out and address them together. The first question is, after the protest has ended, how fast in your assessment can Yoma's businesses recover or bounce back? And any of Yoma's businesses or subsidiaries are affiliated to the military? The second question is, do you foresee Yoma to tank further with the current riot, and should you sell or accumulate? For the last question, in the latest analysis on Yoma, the target price was revised to 34 cents, but the buy call maintained. The Yoma shares have dropped 50%. Is it too late to cut loss, and any recommendation in view of the daily protests and further international sanctions? So I'll just answer them all together. Over the weekend, the military continued with nighttime raids, and shootings were going on throughout the city. The military and the police have killed more than 50 people to quell daily demonstrations and strikes. And I think right now, at least 9 unions covering sectors, including construction, agriculture, manufacturing, they have now called on all citizens to stop work in order to highlight their stand against the military. So as mentioned over the webinars this couple of weeks, the situation actually escalated very quickly since our report on 5th February. And peaceful protests became riots and shootings. So as we are pending Yoma's trading update, we actually have not released a second update, but through our past webinars, we have advised that given the volatile situation, given the tanking of the stock price, you may look at cutting loss depending on your risk appetite. So for the question on Yoma's businesses being affiliated to the military, none of Yoma's businesses are related to the military. And looking at how this protest, sorry, yeah. Okay, can you hear me? Yeah. So looking at how this protest is dragging out, it's very likely that we will see a very slow recovery of Yoma's businesses. And maybe just to give you more color, especially within the real estate development segment, major constructions have been paused since the start of the coup. Yoma Central was actually due to complete in first half 22, and it was expected to bring in close to 100 million in terms of annual revenue, annual recurring revenue. Yeah, but in light of this situation, we are looking at a possible delay till 3Q 22, and likely even further, as in a half-year delay is actually pretty possible given how this situation is actually this situation is actually escalating rather than it not being well, other than it not actually being better. Yeah. And then for the F&B, financial services, and motors, it will also likely see a slow recovery given the better state of the country right now. Most of Yoma's businesses are very much hinged on the growth of the nation and also consumer sentiment. But moving forward, I think looking at the next 1 year, we can probably expect weaker consumer sentiment and nation growth to impact the recovery of Yoma's businesses. Yeah, so this is all for me.
Yeah, can the rest take some of the questions? One question is, what is your view on Aztec Global? 2:30 later, there will be a briefing, so I can try. We will try to brief everyone in in our Monday session. If the other question is to Paul. News headlines. Jardine Matheson acquire Jardine Strategic. Who is likely to replace Jardine Strategic from the STI reserve list? Fraser's Logistics, Fraser's Centrepoint, Suntec REIT, Keppel REIT, and Netlink MBN Trust. My own guess, I guess, is that if you look at the market cap and the high volume, it would be Fraser's Logistics. I think among these names that on the reserve list that you mentioned, Fraser's Long has the highest volume and also the highest liquidity. So I'm only assuming they have the highest free float because of the liquidity. So if I had to guess, I think that would be the one that should be replacing from the reserve list. Yeah. Thanks. Can the rest take some of the questions, especially the REITs and others? Yeah. Okay, the other one, there's an outlook on ComfortDelGro and its TA. I think Viren will help you on the TA, but on ComfortDelGro, no new updates, but I think the minister has mentioned that they're going to review the downtown line. So they're going to review the downtown line so that it will be more, so that the operator, it's very complicated, but under the new rail financing framework, the NRF. So the downtown line is under the old, so the new one is where you don't have to take rail risk. Passenger risk, sorry. So that will be positive for Comfort if that happens. But of course, you ask Comfort, they say no comment because it's all in discussion. It's all, yeah. But if it can only be good for Comfort because then because it's SBS Transit and Comfort, then so at least you don't have to take the real risk. You just want to operate and earn a fee. What it does is it will keep your downside but also keep your upside. But you will just earn more stable income, which is what you want, right? You want to earn the utility stream. But again, we don't have the details, but this is just purely from the press release. So that's the latest update we got from Comfort. The TA Viren can do.
Hi Paul, thanks. I will carry on the technical section. So just give me a while.
As we wait, let me just run through some of those questions that is for me. Share price of Asian Pay TV is on the decline even after announcement of full year results with the DPU maintained. Why are investors still not happy with the attractive yield of 9% peak quarterly and well supported by free cash flow? Is there a big problem looming? I don't think there's a big problem. I mean, my own view, but I think people just lost trust in them because they have cut dividends the last 3 years, continuously cutting, because they were paying dividends using leverage. But when it was, but I think eventually they decided not to. I think 2 years ago, if I'm not mistaken. So they did a massive cut in dividends. So just that the credibility has been hurt because a lot of investors, right, they cut dividends so aggressively. So investors are not really comfortable anymore because of how much they've cut dividends. But they had to do it, I guess, to make it more sustainable. So there's a de-rating of them, not so much problem, but de-rating. So that's why the share price continued to come down, even though the yield is high. Thanks.
Okay, so I'll just read down all the questions over here. So I think Yoma is in the spotlight once again. So let me locate. Yes, this is my Yoma. So for Yoma, I think a few webinars ago, I mentioned that this the zone that I'm looking for is between 165 to 156 to 165 region, which is over here at the blue zone. I think it was good last Wednesday. I think 3rd of March. I think it has a rebound, but I think price did not sustain above the high. So there was some sort of like impromptu buy. Then after that, lack of demand, it pushed prices down again. So if you can look at over here, first of all, like I mentioned, there is a very strong breakaway gap. Okay. Then after that, price actually make lower lows already. So price actually, you can see some of the intraday reaction on the buying side, but I won't think that is strong. So looking at the larger weekly chart, this is the falling wedge. So I would prefer prices to actually test this region at 141 to 156. Okay, so Then the question is, does this region consider like forgo one? I would say no. We will still maintain it, but I think that the upside is still very, very what do I say? Not very strong. Given now, all right. Okay, so that's for the Yoma side. Okay. Okay, so the next one is ComfortDelGro. ComfortDelGro, I think I issued a sell call, I think 2 weeks ago based on here, but price was remain support at 155. And then subsequent price decided to edge higher, but do take note that we are still within a range. Price has not made significant higher highs, so therefore we are still very careful. And then if you use the Ichimoku to map out the trend, it's still very ranging. And then the key thing is prices is still trending below the clouds. This is the Senko span A and B. Hence, if we are looking out for a breakout or for a continuous upside, then we need to break this resistance zone between 1.68 to 1.71. Okay. Another thing is you can look over here is the upside is a strong impulse up move and then followed by a correction. This channel is like you can say it's a flag, but to go into closer, I think this flag may be invalidated. So the reason why is because you map up the period of the upside as compared to the correction. I think it doesn't tally. So in this retrospect, I think prices is still going on into a ranging type of momentum for ComfortDelGro. Even if break the resistance zone, I think the next one by 1.81 is the ultimate resistance that will face tough selling ahead. Okay. All right, so move on to the next one. Okay, so the next one is the DBS, iFast, and ISDN. Okay, so DBS, good news is the head and shoulder is no longer valid as it breaks new high. Same for UOB, OCBC, I think it has making breaking new high. But today, what I fear is that it may be an island top today. So if there's a correction, then you may look for this support term resistance at 27.57 before rebound. I'm still aiming for a target near $29.50 to the $30 region, which is over here. So if you look, you look here, there's an island reversal gap since last like 3rd May 2018. I think back in 4th May, I think this is like 2.5, 3 years ago. Yeah, you can say 3 years ago there. Okay, there's island reversal and price has been making lower low. So this based on a strong momentum, you can see over here, price is definitely has a chance to return back to the mean, back to a $30 top. Okay, and then you look at the weekly chart. All right. Yeah, so the weekly chart, I think this ABC, this is the larger correction W and the X. So $30 may be a critical part for that. So the only way to test whether it has been broken is to break out of the larger corrective flag over here. All right. So that's for DBS. And next one is the ISDN. So ISDN ranging, I foresee a potential flag momentum, flag formation ahead in response to this large bullish wave up starting from last year 2020, March 2020. So it has been a year of close to a year of bullish upside, but you can see the N wave. So the N wave has been on the upside. This like a 3 N wave from a larger bullish N wave, and then a 2 bearish down N wave. So we got another 3 to form the larger complete 1 N wave before you hit up. But the question, but that is very long going forward. So we do not know when it will happen. But if you look at the immediate trend, based on the Ichimoku, you can see that price has already trended below all key indicators. So we are facing a bearish death cross. So in fact, price rebounded and then test below the support term resistance level zone. Okay, and then price actually rejects it and then come lower. So hence, I think any up move will be much more corrective. The main upside will be remain at 0.415 to 0.445 for rebound. So so let's see how ISDN develops as price upview itself. Okay. So lastly, by Jeff is the IFAST. IFAST, I'm on a bearish tone since it reached up the all-time high. Okay. So based on wave theory, I think we have completed a wave 5 over here. So we are A, B, and then C. So potential rebound will be at around $5 to $5.30, 499 to be exact. Okay, so this is the region. First thing, I think IFAST has really formed the first death cross over here, and then the lagging span is set to cross below the candle, the gap zone. So once it's crossed below means we have a 2 bearish death cross signal. So the next one is once it is going to the cloud, expect some sort of like turbulence going ahead. All right, yeah, and then the single span A is flat, B is flat as well. If given a tick one, as price is aging closer to the cloud, our advice cautions to on IFAST. So IFAST, look out for support between $4.99 to $5.30. Right. So the next one will be micromechanics, and then top left. Okay, so micromechanics. Looking at that, I plotted a trend line, immediate trend line. This is the sub-primary, and then this is a sub-secondary. So the sub-secondary trend line has been ready, is currently ongoing testing. So potential rebound will be in this this hollow zone between the primary trend line and the secondary trend line. All right. So if you look at that, I think Ichimoku has already shows a bearish death cross. So we are on the note for further downside. All right. So you can look at the support between $2.80 to $2.67, whether there will be a rebound is within the within a hollow zone between the primary and the secondary. So yeah, and then price I think will set to continue for further based on the bearish momentum today. All right, so Top Glove is another stock that is extremely bearish for now. Okay, so first of all, I think I expect wave 5 to complete and then form an upside, but due to the climate and the environment of the surrounding the glove stock, including I think MedTech, UG Healthcare, I think it has dropped significantly. So expect some further downside correction to form wave Z. So wave Z potentially 120 to 141 may be a rebound, but if this zone is invalidated, then we might see price go beyond 80 cents. So this one whole complete cycle of wave 1, if you look at that, I think we are able to go into a very deep correction around at 88.6 region. So yeah, so it's around 0.79. Okay. So yeah, okay. So last one, Ascender CICT. Okay, so I'll do CapitaLand Integrated Commercial Trust. Yeah. So CICT, I'm still bearish for now. Although that it has been ranging for now. First of all, I think prices has already formed a death cross of the Ichimoku. Then, but I expect price to actually rebound from 1.91 to 1.95 region. Okay. Reason is because I think this confluence with the D with the base of the rising wedge, and then there will be one more upside to 240 region. Okay, but ever since it breaks out of the falling wedge, I can see over here, price has been ranging, so it's not very explosive kind of bullish momentum. So hence, I think that CICT lack the bullish momentum to go forward. So the only thing that that will give you a clue is once price breaks above 2.21 immediately, over the next 2 to 3 weekly periods. Okay, so means in other words, in the next 2 to 3 weeks, within, okay, price need to break 2.21 to confirm the bullish upside. Otherwise, I'm remain neutral, tilting on the bearish side, and then aiming to rebound to buy rebound at 1.91 to 1.95. Okay, right. So ascenders, I think ascenders, I'm waiting for a rebound over here. So it fails to clear above the gap, so it filled up and then price actually hit below after it clears above the inverted head and shoulder on the upside, force breakout, and then back to the downside. But I think as price has not break 2.88, I think I'll still consider a range. So a range within the range, some sort. Okay, so but if price because price may have a tendency to rebound at this region at 2.88 to 2.91 before it actually clears, before it actually reach above between 2.7 to 2.81. So ascenders much of a neutral zone despite it breaking below 3.05 resistance and support turn resistance, I mean, sorry. All right, and then for Escort is the same. I think Escort it breaks below the cloud, trending below, but the lagging span is nearing to the candle. So I would say that Escort right now is partially ranging, but on the tilt side, I think it goes down to a support zone at 0.86 to 0.9 in the long run. But do take note of the rounding bottom over here. So if price is to break 1.06 to 1.07, then we will see the next immediate target resistance at 1.19 to 1.15. All right. So the next one is, what's your view on Yang Zhijiang? I don't know if you're referring to the technical aspect, but if I can share about the technical aspect before I pass my time back to my colleagues. Okay. So Yang Zhijiang, yes, Yang Zhijiang has reached my resistance zone, which I've been sharing a lot of time. Gap up and then there's a reversal. So this might be a mini island reversal top on the intraday chart. So although it breaks up above, so it is considered like a breakaway gap. Means that signify a new trend to break out of the resistance at 1.11. But if it managed to close back below it, then I think the breakaway gap bullish upside will be limited. So expect some form of correction. So anything we need to wait until end of the day to see how the prices react to the closure by I think F518 when SGX closed for trading. All right. So I think okay, then the next question is, should we sell AEM? I think I issued a sell call on AEM last week, I think, or 2 weeks ago. So yeah. Okay, so I think why cannot see other audience questions? So this week we decided to try something else. All right, so hence, yeah. Let me do some question. Let me do some settings. Yep, you can see the question now. Yeah. Okay. All right. So I pass my time back to my colleagues. Thank you.
Thanks. Can we just run through the questions from the top on the charging? Anything from you, Terence? If nothing, I don't think they actually mentioned it, but if there's nothing, we move on. Okay, then let's move on. What's your view on Zhang Zhijiang? I think we don't cover, but I think it's all about the container. I think we listen in, but the problem for Yang Zhijiang sometimes is they got so many moving parts. They got FX, then they even into venture cap. They're even investing into venture cap funds. They have a loans business. So sometimes it's not the easiest thing to analyze Yang Zhijiang, although we don't cover. But in terms of the shipping part, they are doing well because containers, of course, doing well, and they're getting a lot of orders for container. The other one to watch for is the LNG carriers, because the Yangtze River can carry LNG carriers, so that is another opportunity for them. But again, we will never. I mean, it's going to be very tough. Whoever covers this, you have to worry about all every quarter there's mark-to-market gains, then mark-to-market loss, then FX gain, then FX loss. So we don't really have a really good details about them. But they should still do well in the sense that there's still a lot of container vessels being ordered. So that's the only thing we can say as a trend. I think the AEM given yesterday, I think Viren has probably, let's see, why cannot see other audience? TA on CDI venture. Okay, how rising bond yield can cause bond prices to fall? How does it affect stock market? Yeah, I mean when bond yield rise, of the prices will fall. I think if you buy a bond with a 1% yield, then but the market yields are not 10%. Your 1% bond yield is practically worthless. I mean, because not worthless. You will just have to adjust back so that investors can get that 1% coupon. So that's why the prices will fall. It should benefit it can benefit the market like we showed you in the chart, depending on why the yields are rising. If the yields are rising because growth is coming back, then that will be one positive reason why the market can rally. And of course, the flows could also come to stock market. But again, this is all innuendo and quite obvious. We don't have the data to show you that in terms of the flows. No more growth for MedTech and for MedTech and UG. Because of the pandemic, the market just getting nervous that the earnings have already peaked, and like I think a previous attendee kind of mentioned it before, very well said that people view this big gain as just a one-off. We don't think it is, but again, it's hard to convince people until the pandemic is down. Then you can see that the growth demand is too strong, even in the post-pandemic era. But I think market just derating, and like what the attendee kind of kind of phrased it very well. The people see this big jump in earnings as just a one-off. So that is very hard to remove the mindset from a lot of investors, although we don't think so. But yeah, I think that's the right one. Interesting way to phrase it by one of the attendees, I think last week. Natalie, can you answer the phrases?
Okay. So good morning again, everyone. I see several questions here related to REITs. So I'll read them out. First of all, FCT raises Centrepoint Trust and Ascendas REIT prices have been dropping over the past few weeks. Any reasons? Should we continue to hold or sell? Second question is, as REITs generally trending down in recent weeks, what is your view on this, and also the outlook for the REIT sector in the next 6 to 12 months? I guess there's also another one where an investor, so another one would be pertaining to Capital DC and FCT. Why does it continue to be weak? As well as another attendee has mentioned that, instead of benefiting from the recovery of COVID, the attendee's entire REIT portfolio has dropped by 10% since January, and he has been holding retail, logistics, industrial REITs. So with the rising interest rates, should you hold or sell? So I'll take all these questions. I think in general, it's just about the price weakness of the REITs and how it doesn't seem to be picking up despite the recovery underway. So I think this has a lot to do with first of all, with relation to the counters that we do cover, FCT, Ascendas, as well as Capital DC. So we still have buy/accumulate calls on these counters, and fundamentally nothing has actually changed. FCT continues to be a well-positioned, dominant, and suburban mall that is benefiting from the increase in daytime catchment within the heartland area. So that continues to be in play, and even from 4Q, FCT has already improved. The tenant sales has already reached back to pre-COVID levels. In fact, it has surpassed pre-COVID levels. So it continues to be strong. And in terms of Ascendas, there's still a lot of growth prospects for Ascendas. They have been acquiring, and also trying to utilize their development headroom. So meaning to say that the kind of yields that we will see from these assets coming online will be higher. And in a sense, Capital DC as well, the price right now is actually a pretty good entry in terms of where our target price is. So all of these counters we continue to remain positive on. So then coming back to the problem of the declining share prices, which we believe that is largely due to the rotation, where a lot of investors are now rotating into cyclical stocks and or growth stocks, right, rather than defensive plays like your REITs. Yeah, so fundamentally, actually, nothing has changed. And I want to address share prices. Sorry. I want to address interest rates. So in terms of interest rates, yes, in periods of increasing interest rates, that is negative for the REITs, because a large portion of REITs earnings, almost 30%, is based on finance expenses. So it's tagged to the interest rates. Yeah. So that's it, right? Right now, where we are, we always monitor the SAW, the 3-month SAW. So for 3-month SAW, latest number is about 0.25%. And then we compare that to where we were maybe throughout the whole of the year, 2020. So throughout 2020, the 3-month SAW was about 0.5%. And we look at 2019, which we know was a bull run for the REITs, and they were very aggressively acquiring. And during that period of time, the interest rate 3-month SAW was anywhere between 1.7 to almost 2.2%. So where we are right now, even though there is a risk of interest rates rising, and of course, yes, for certain sectors, like your office, some selected retail REITs are still recovering. Industrial activities also picking up. So I think where we are with the interest rates, we are still in a much better position compared to where we were in 2019, where the interest rates were around 1.7 to 1.5 percent. So that's it. I mean, we of course we do monitor the interest rates, and anything hitting close to the 1 to 1.5% SAW level, we will start to become more cautious and probably turn a bit negative towards the REIT sector. Okay, so I think that addresses basically most of the concerns. With regards to the share prices dropping, even for the logistics sector, especially even the larger cap industrials, they have not picked up from where we were like 1 month ago, and we believe that it's really due to the cyclicals, the favoring of cyclicals. Yeah. So I hope that answers your question. I think we have another question here, specifically on outlook for Manulife, Prime, as well as Cromwell. Okay, so I'll talk a little bit about Manulife. So actually, Manulife's full year results came in last month, February. So in terms of, I think the attendee also wants to know what should we look out for. So of course, for Manulife, it is my belief that the US office occupancy and absorption has been on the decline, and the net absorption has been negative. But I believe that Manulife, with their portfolio of Grade A as well as Grade A and trophy assets, they are not seeing this same trend. The occupancy remains high, somewhere in the 95%, if I'm not wrong. Let's see. Yeah, around the 95%. We also look at the collections, shadow space. So for Manulife, I think the shadow space actually has fallen within their portfolios, and the tenants that are interested or may potentially want to sublease is only about 3 to 4% within their portfolio. So in that sense, I believe that Manulife is sort of a casualty of a very negative mindset, or rather the whole outlook of the office sector has negatively impacted Manulife. But then again, we see Manulife's fundamentals actually still holding strong. So that's for Manulife. I think Jie Hui can touch a little bit on Prime. Jie Hui, if you're there.
Okay. So just to touch on a bit on Prime, I think similarly like what Ned mentioned. So for Prime, their portfolio still remain largely resilient. Rental collections are actually very, very high at 99%. And then in terms of leasing strength they actually managed to lease leases at positive rental reversions of like 7.2%. Their portfolio actually is not largely, but there is potential upside to this portfolio in terms of rental reversions, which will help the portfolio in the sense where, hang on, sorry. Okay. In light of this possible shift towards a hybrid work from home model, at the very least, you know that if the portfolio is slightly under rented, it will actually help to support rents that may be coming down within the markets that that Prime or Manulife are in. Yeah. So just to build on for that, for Prime's markets, actually there is limited upcoming supply within Prime's markets, in the sense that most of the upcoming supply has already been released, except for one market, which is I think, if I'm not wrong, Salt Lake City. Yeah. So and also I think, just to add on, yeah, the minimum expiries coming up for both, I think, Prime and Manulife will actually have to support the portfolio in the coming 2 years. Yeah. So I think maybe just to add on to the point where like what to look out for Prime. For Prime, there were vacancies left last quarter at 2 portfolios, which actually were vacant since first half of 2020. Yeah. So on that point, we are actually looking out for the occupancies at these 2 properties, and hopefully in time, Prime will be able to lease out and fill the vacancies above average portfolio occupancy of 92.4%. Yeah. I think there was this part on Cromwell. For Cromwell, we do not cover, but then maybe just to give some color, their portfolio actually remain quite resilient as well. I think their MPI was actually slightly above that of last year, mainly due to income from new acquisitions, and their portfolio also remain, as in their portfolio occupancy remain high at 95.1%. Their rental collections were at 93%, if I'm not wrong. So I think just to wrap things up, we do not cover Cromwell, but for now, things are still looking good for that counter. Yeah. So I think this is all from me, unless Ned has anything to add.
Yeah, I think nothing for now. We'll pass on the time to our other colleagues.
Yeah, thanks. Let me just try SPH and Singpost. Any turnaround? Let me try this. SPH and Singpost. Any turnaround or new development that can affect the share price recently? I think for SPH, we know, it came out in the news that there was some rumor of them having a delivery company, I guess a delivery unicorn in Korea. For them, the recovery in economic activity will benefit them. I think for SPH, as we know, they rely a lot on media ads, so that will benefit. Likewise, even for Singpost, recovery, actually, because of the economic recovery, they do generate income from all those mailers that you send through the post, those sales mailers, so that they actually benefit from that. But the bigger one will be if they kind of revamp all the mailboxes. But I think we'll deal with that later on. Because if you do that, then they will have a very low cost entry into everyone's home through larger boxes. Then they can do a lot more e-commerce deliveries. But that's a longer term goal. Again, not very good answers, but just ticking off the cuff. The other question is 5G negative to Asian Pay TV as more broadband subscribers will switch to 5G? I think that's a good question, because that's a question you can also ask Netlink Trust, because once 5G comes, will we all switch to 5G and ignore the fiber? I don't think so, because the speed for fiber will continue to rise, and we will all just hunger for faster speeds. But we don't think so, and that's also, you got to assume that 5G is unlimited and it's too costly for a lot of the telcos to do it. So at this juncture, of course, never say never, but at this juncture, it doesn't seem so. I don't think it'll be negative for them. And it's a question can be asked for all the other broadband players too. Thanks for that. Paul, your view on Oceanus price movement last week, and is it worth to invest? Really no comment, like too sensitive. I can't really say much on this. But hopefully those who had come in our prior webinars, I think most of their earnings come from trading import. They own one importer of consumer goods into China. So most of the revenue, and if there is any profit, I mean most of it comes from this particular company. And the other thing they're going to do is to build like aquaculture nearer to urban centers. I'm not sure if anything has changed, but this was I think when they did the webinar with us in November. So these were some of the business initiatives. Apart from that, I'm not sure about that. So these are the two main thrusts of the business. So I'm not sure if that is good enough to push them to, higher, but that is what they messaged up.
Maybe I will just pick on the next question, which just asks what's the difference between PIPE investors and sponsor for SPACs. So for those who are not aware, PIPE, PIPE actually stands for private investment in a public equity. So he's asking for the difference with SPAC. So the difference is that the approach is different. When you have private investment in public equity, most of the time, usually it's the company they wanted to raise funds. And that's why they turn to all those private investors to sell them shares at undervalued price in order to raise capital. But if you look at SPACs, the company may not necessarily need funds, but SPAC, the ultimate aim is to actually acquire companies. So yeah, the approach for these two is the main difference. Yeah, of course, if you are talking about SPACs, I mean, if they may also end up turning into a PIPE investors if the capital that they have on hand is not sufficient to acquire the whole company itself. And then they may temporarily become a PIPE until they raise sufficient funds to acquire. Yeah, so I hope that answers your questions.
There's one more question. Does discuss AEM and UMS and micromechanics piece, and do you have any upside or all? I can't speak for AEM because again, I was mentioned quite confused about their business. But for UMS, we think they should do well this year. I think, as you know, their biggest customer is Applied Materials, and you know there's already a big shortage in wafer fab in semiconductor chips, and their biggest customer, of course, is like TSMC, the front end. So I mean, from the top down, it should not be a surprise that it will be a record year for UMS. And their PE, I think right now historical is probably low teens. So I think UMS is looks like a good bet. I mean, from a top down business. I mean, I don't have the details, we don't cover. For micromechanics, we cover, and we think it is a attractive stock at these levels, because I think right now the yield is 5%, if I'm not mistaken. Correct me if I'm wrong, but if not, it lowers probably like, if it's not, maybe 4 or 5%. So you're getting a semiconductor stock paying you 4 to 5%, and they will, and you know, semiconductor, I think like Chuno has did a report, it's a multi-year structural theme. This is not like a one-off gain, and a lot of these stocks are quite cheap, mid-teens. I think UMS probably like mid-teens now, and they're giving you a 4-5% yield. So I think these are good investment proposition. I think they look good. I mean, from I don't have the numbers, I should have, but for me, UMS and micromechanics look attractive at these levels. Although UMS, we don't have any coverage.
Hello, everybody. I think it's time for now for us to end our webinar. So yeah, so we will see you all next week, and then yep, everything will remain the same. So see you all next Monday. We apologize for any Q&A that's not being answered because I think time is running out. So apologize in advance. Thank you.